Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Let's turn now to Homin Lee, senior macro strategist at Lombard Odier, with a little bit of a closer look here at China. So you're neutral on the market with kind of a cautious view. Why?
Well, I guess the economy has, especially the manufacturing sector, has done pretty well due to robust demand overseas and this increasing success at getting more market share overseas. So the combination of this will definitely create a bit of upside for 2024. So, the growth will be closer to 5% target. But can the economy do better, next year and the year after? We still have some structural issues that have not been resolved. The real estate sector continues to struggle despite many easing measures from Beijing. It's also pretty clear that with their main asset class struggling, the domestic consumers are still relatively cautious. If you look at the bank loans, for instance, for households, it's actually pretty weak. It was pretty weak in May. At the sentiment indicators are still pretty depressed. So, and the prices are still pretty low. So the domestic, manufacturers and suppliers are still struggling to get secure margins for their own businesses, and the share of loss-making business for the industrial sector is about a third. So in this kind of combination, it's very difficult to get the enthusiasm up for the medium to long term.
Yeah.
But it's also true that the leadership is aware of this situation. So in July, it's possible to try to deliver some new reform measures for the real estate. So, these two factors basically, cancel each other out. And that's the reason why we are still comfortable to maintain a neutral position on the market.
That's an interesting point. It's kind of consistent with what the government is saying about really making sure that the manufacturing economy is doing well so that, the real estate segment can heal, if that's the right word to use. I guess it's fair to say that China has really perfected the manufacturing economy. I mean, the efficiency, the modernization, automation, robotics, everything that's being deployed right now and has been for a number of years is really kind of, unmatched globally. But are you concerned now that we're talking about trade wars potentially and geopolitical risk that may be shifting slightly?
That's exactly right. The part of this development is actually not sustainable in the long run because it will, definitely intensify frictions with trading partners. We already had, reaction from European Union for the EV sector, but that dispute, even though the recent announcement was a bit milder than we expected, so that was slightly encouraging. But the thing is, the dispute will spread to the other sectors as well, like solar panels, wind turbines. Semiconductors and the other sectors. So, and you are aware that Canada is beginning to think about the EV related tariff. Japan is now beginning to increase restrictions for trade related to maybe Russia and Ukraine. So these issues are set to worsen. So the fact that China is gaining the market share is positive in the near term. But that tension is definitely there, and it will be even more difficult for the exporters going forward in the medium to long term.
It's the first time in a long time that China seems to be a little bit more concerned about this than Europe and the United States. I mean, you look at the speech from Chinese Premier Li Qiang yesterday at the World Economic Forum, and basically he's talking about the regressive actions of decoupling and that there would be negative consequences. He thinks that it would drag the world into a destructive spiral. You're not hearing Europe and the United States talk about, losing a bit of contact with China as being that big of a thing on the global front, but China is. Does that show you that they're quite significantly nervous about this decoupling?
The decoupling is real, and it's already happening, and it will be very difficult to reverse it given the political sensitivities in different capitals around the world, including Beijing. So the loss of trust here in the system is really sad thing to watch, and it will definitely reduce efficiency at the global economic level, at the global level going forward. So it's really, a setback, for long-term outlook. But you're absolutely right. This, loss of trust is going to stay. And, especially with the political, event coming up in the U.S., the dialogue will likely worsen. And, as far as the Chinese exporters' outlook is concerned, they're doing well. And part of this is, in fact, the actual innovation happening in China. But the reaction to it will definitely get stronger.
So we know that
because it.
I'm sorry, Homin. The challenges in China typically create ripple effects across the APEC. You're in South Korea. Can you give us a sense of how you're seeing what China is going through kind of resonate through the South Korean economy?
So for sure, one of the successes of, the factors that drove the success of South Korea in the past 20 years was the globalization and the collaboration with China. So the fact that the decoupling is happening, you will create some ramifications for the business sector here. For instance, if you think about the memory sector in South Korea, a huge chunk of the installed capacity is still in China. And, the leading manufacturers need to figure out how to, manage that exposure going forward, especially because they're now beginning to build facilities in the U.S. under the U.S. conditions. So these are the issues that they need to deal with. But at the same time, some businesses, are feeling a bit more optimistic because, there is this expectation that maybe the greater restrictions from the U.S. and Europe could create opportunities for South Korea. Battery sector, for instance, the leading battery manufacturers in South Korea, they were losing market share to China. So potentially this new tariff that's coming up could open the door for them. So it cuts both ways, but definitely the navigating this is not going to be easy.
So put that all together, like, for instance, this morning we're seeing a rebound in Tokyo Electron and SK Hynix. It's up more than 3%. What's your number one call at the moment?
Well, the number one call in Asia is that we are still long dollar against select Asian currencies. We do think yuan will soften a bit against dollar going forward, given the macro challenges there. And for Japan, we do think the adjustment by Bank of Japan will come up in the July policy meeting.
All right. Well, we've got weakness in the end this morning. Dollar yen's at 159.78. Homin, thank you for joining us. Homin Lee, senior macro strategist at Lombard Odier. Well, joining us now on the program to take a closer look at markets is Geoff Yu, senior EMEA market strategist at BNY. Geoff, thanks very much for being with us. In equities, we've actually had considerably more volatility in some of the individual stock performance than we have seen at the index level. So in some ways, I suppose you could say that what that translates to is it's a good time to be a stock picker. Are you that dude?
Well, at this point, I think with respect to stock markets, we've got to take into account seasonality. It is month end, so some rebalancing going on. It is quarter end as well, so it amplifies things. But I think it's not just in equity markets where you want to be a stock picker. I want to be a quote unquote stock picker in currency markets as well, and bond markets. The idiosyncratic risk in countries are the same as looking at company fundamentals as well. So this, to your point. Broad brush risk on environment, that certainly doesn't really apply anymore, especially with the Fed comments that you've just played, especially if it's a higher for longer environment. Then you've got to be very careful in asset allocation, where you want to own, who you want to own, and how you deploy money.
Yeah, we're fortunate to be speaking with you from Beijing, so I'd like to get your take on the overall economy in China. But talk to me about some of the geopolitical risk that you see right now. Yesterday, we were talking about Canada imposing tariffs on Chinese EVs. We know what the situation here in terms of the tariff situation is with the U.S., also Europe. And then a moment ago, we were talking about OpenAI taking additional steps to curb China's access to AI software. How do you view the geopolitical environment right now, the U.S. versus China?
Well, I think, broadly, all of this is being factored into asset allocation, right? So, to the point regarding the last question about, stock picking, I think these premiums or discounts are being factored in as well, but all sides are talking at this point. China and EU are discussing the situation with, tariffs up ahead, how that's going to impact industry. But broadly speaking, when it comes to the domestic economy, I think that still is going to be the focus, how to continue to lift sentiment. And in asset allocation terms, for much of Asia, where we see significant underweights from our own client flow, there is an opportunity there. But at the same time, we need to see policies follow up as well. So let's not get too distracted on the international side of things. And let's see if Asia as a whole can pick itself up in terms of generating growth in a challenging environment, I might add.
One of the things about stock picking that I think resonates is it's about the stories. And I think you could apply that to all asset classes, including your specialties, the bond market and currencies. For instance, these are comments that play out pretty well with NVIDIA. It's probably a difficult thing to short at this time. You get your head handed back to you, basically just because of valuation. It's a story that seemingly is still intact. Don't overthink it. Are there some parallel stories that you see with other asset classes? One or 2 weeks ago, when we're talking about the situation in France, and we were asked about safe havens, right? So, what would you consider as a safer asset right now? The European government debt or tech stocks in the US? And I suppose a lot of asset allocators would pivot towards the latter right now, which does sound counterintuitive to some extent, but. Many times, I would say clients take the approach, if it ain't broke, don't fix it, right? And being in tech, being invested in the US has worked. We actually have to acknowledge that. So rather, think about valuations in the US. Let's think about the discounts in Europe. Why are European companies or why are European bonds, struggling to attract the kind of flows that US tech is generating right now on a volatility-adjusted basis as well? I look at real rates in the US, and then I look at real rates south of the border in Mexico. We're talking 1% in the US compared to 4 or 5% for a Mexican equivalent. Yet over the last few weeks or so, we've seen the dollar outperform as well. So is it too much of a premium in US assets or a discount elsewhere? That's worthy of discussion. But time and time again, US stocks have shown their worth. So I think that is basically cornering market investments right now.
So what is the level of risk in Europe, even if the ECB begins to accommodate and apply a few more rate cuts here? Is that enough to assuage your concerns at all?
Actually, if I look at the euro where it's trading, what I am concerned about, somewhat counterintuitively, is the ECB. And I view if there are many, many reasons to be bearish on the euro right now, and perhaps the European economy, politics, oddly enough, is actually not one of them. So the French debt reaction, I think that was more due to over-positioning ahead of time, ahead of the election announcement, rather than fundamentals itself. I look at manufacturing PMI. In Europe, the cornerstone of European industry, the car industry in particular, that has been contracting for God knows how long now. Yet the ECB is focused on the more narrowly defined services inflation. So I do think that the ECB will need to cut a lot more. That would assuage my concerns. So if anything, the ECB is not cutting enough right now.
Yeah, and that would even strengthen the dollar more. I'm curious what you think about this. I've listened to so many sessions with you and Tom Keene on surveillance. I feel like I know you. And I know you look at the U.S. I think most people would probably think that the neutral rate on the economy in the U.S. is somewhere between 2.5% and 3%. The Fed funds rate's at 5.37.5%. How long can that go on without doing some damage?
How long can that go on? In terms of tightening financial conditions, but we just have to go back to the data, and the data right now, as many Fed members have highlighted, is just not showing signs of slowing down. So there may be an argument that for higher for longer or long-term equilibrium rates are being pushed higher. Now, a recent speech by the Swiss National Bank's President Thomas Jordan also highlighted that equilibrium in rates in Switzerland, known for low inflation in the past, may be a bit higher than expected. So to your point about structural level of rates and the level at which they need to be to do some damage may be higher across the board than we previously expected. So I think that is really supportive of the dollar right now. And to be frank, apart from the Swiss and the yen, maybe dollar downside is going to be quite limited at this point.
Geoff, very quickly, before we let you go, since you're in China, let's do a little bit of walkabout economics. What is the situation there on the ground?
So, right now, we always say sentiment can be stronger, than we would like it to be. But there is a effort seen to try to support the economy, and also the PBOC comments. I think throughout the year they are redoubling efforts to do so. What are the catalysts for some? I just don't think with my international hat on, there is enough focus on some of the opportunities here at this point. So we remain positive on asset allocation in China, mostly because the extent of weightings is actually quite soft. Okay, so sometimes you think about price action. No one owns China at this point. That's the point. I look at our flows. No one owns emerging markets in general.
Yeah,
so that's where the opportunities are.
We got to go, Geoff. But that's why I was wow. It's interesting to hear. We'll save that for the next time. Details, Geoff Yu from BNY. Let's get to our guest, Mark Luschini, Chief Investment Strategist at Janney Montgomery Scott. Mark, thank you for coming on the program. We had the Fed Governor, Michelle Bowman, actually worried about upside risks on inflation. It's a little counter to what we've seen in the past couple of months. And the Fed Governor, Lisa Cook, went the other direction, saying that she sees inflation gradually improving this year. We had Steve Eisman on surveillance last night, my time, and he said it doesn't matter. 550 basis points of upside, one move here, one or two, it just doesn't matter. How do you see this?
Well, I think there's a case to be made that could probably defend both Fed governors' positions. At the same time, though, several of the leading indicators that we consider in factoring in the somewhat guesstimate work that goes into ascertaining the likely direction of inflation suggest it's more likely to continue to cool than necessarily reheat. Now, maybe in the case of Governor Bowman, there was an acknowledgement of the earlier in the year readings that came in a little bit hotter than expected. That can't obviously be dismissed at this juncture just because we've stacked a couple of good inflation readings subsequent to that. So again, it's a heavy reliance on data and a lack of commitment or conviction on the part of the Federal Reserve members with regard to what their next move might be, allowing for the data to serve their reaction function as opposed to speculating.
So if you're right, and we do see evidence of cooling, it may manifest Friday with that PCE data. We know it's the Fed's preferred measure. Will that change consumer behavior? I mean, if we start to see inflation come down, I noted today that the Conference Board's Consumer Sentiment Index eased a bit. I mean, the survey also pointed to a more muted outlook for business conditions and some softness in the labor market and incomes as well. I mean, so I'm wondering whether if inflation comes down, that the consumer may react in a way that suggests a little bit of positivity.
Perhaps ultimately. Certainly the University of Michigan survey is tied more closely to inflation readings than is that of the Conference Board, which tends to be a little bit more waged and job market driven. But nonetheless, I think the angst in the consumer at the moment is not so much the fact that they don't recognize that inflation has been cut by 2/3 from its peak back in June of 22 of 9.1%, is that prices in general aren't falling. And so it's the elevation of prices rather than the rate of change in inflation that is causing some, anxiety on the part of the consumer that you're seeing by way of perhaps some modest slowdown, weakness in spending that evidenced in the most recent retail sales figures. So, it's always a function of watch what they do, not what they say. But at the same time, you can't ignore those confidence ratings that do suggest, particularly as it relates to their responses to their intentions to buy durable goods items or take vacations or what have you, are still really weak.
But you know, that's where time figures in, because in time people would get used to the current rates as long as they're not going up. But I think it's kind of interesting when you think about, okay, if you have growth faltering a little and you have inflation coming down, it's kind of a no-brainer that the Fed might want to cut. You still don't know when. But what's interesting is, what if you have inflation come down but growth remains firm? Could the Fed stay higher for longer in that environment?
I think they could. If inflation would come down, though, they'd have no reason to. I mean, their battle right now seems to be solely focused on inflation, since they're still at, or maybe even slightly below, what they deem to be full employment in the country. So that side of their dual mandate is still in line with their goal. So if they've in fact feel increasingly confident, they can declare victory over stamping out the ravages of rapidly rising inflation, then there's no reason for them to continue to hold interest rates high if, in fact, the economy seems to be motoring along at a trend or above trend pace at the same time concurrent with falling inflation that is on a glide path that they have a high degree of certainty is going to land at or near their 2% target.
So, Mark, I'd like to apply everything that you've been saying into an investment strategy. What would that look like at this point?
Well, I think, for me, it tends to be that, your bias should be at worst to be, market weight, whatever that is, congruent with one's target weighting for equities in a portfolio, 100% or balanced in a 60-40 allocation, whatever might be appropriate, and go overweight at times in which we've seen a deep enough pullback that would warrant, either shifting monies into equities from bonds or adding new monies to the equity market. I think the only time you'd want to consider underweighting equities is when we're in the midst of a condition that by all accounts appears that a recession is inevitable, because that's where you experience the bear market drawdowns of significant orders of magnitude. And for the moment, that doesn't seem to be an imminent threat. So I think the window for equity prices to continue to advance, perhaps not quite at the same pace as we've seen over the first, call it, half of 2024, but nonetheless advance, is still open. And I think investors therefore should stay committed to their equity positions.
But Mark, is this a better time for stock pickers than index buyers?
Well, the index buyer has been rewarded by the fact that the disproportionate representation of tech and tech-related companies have really done all the heavy lifting. If you consider, the Magnificent Seven's return of, call it 36% year-to-date versus the 15% return for the even cap-weighted S&P 500, you've benefited from being an indexer, if you will, in that respect. At the same time, though, I can't help but think going forward, it may be more rewarding to spread bets around because valuations are exceedingly demanding.
All right, Mark, thank you so much. Mark Luschini there from Janney Montgomery Scott.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.